Hey, my name's Ben Yenny. I'm not a filmmaker. I help filmmakers make money with their work. Today we're talking about staged financing. Thank you all for being a part of this channel, even while I was gone for a couple months because I ended up moving across the country. This is my first video from my brand new home office, so let's hope it turns out well. But before we begin, it's important to note that this is not traditional film financing. That said, it is coming into vogue, at least more now than it used to. There are some pros and cons to it. But before we get into that, it's important to say that each round has a different percentage of the total raise. The development round is pretty tiny at about 5%. The vast majority of funding for your film will come in during the principal round, which will cover both pre-production and principal photography. Post will come in at about 30%, and finally you'll end up with P&A. It's likely that if you go the traditional distribution route, a lot of this P&A money will be put in by the distributor themselves. Now, as I said, there are some pros and cons to staged financing. One of the pros is you're not holding on to your investor's money when you're not currently using it. I think a lot of filmmakers underestimate how big a deal that actually is. Investors have a lot of different options and different places that they can put their money. So if you're holding on to it, that means that they are foregoing other investments. Of course, the con to not having all the money you need is that it becomes easier to run out of money before the film is completed. On the other hand, raising smaller amounts, particularly for development, can help you get a package that you can actually fundraise for. What I mean by that is most investors need you to have distribution and name talent on board before they'll give you any significant amount of money. Most distributors need some level of name talent before they'll commit to distributing your film, or the film needs to be already done. And most name talent won't come on unless you have money. So the easiest way to skirt this problem is to raise a bit of money to get the package you need to finance the entire film, or at least get through principal photography. Then you can go after the other bits you need to actually make the film more than a script and turn it into a completed work that you can hopefully make at least a bit of money on. Hollywood doesn't always keep up with the latest trends, even in their own industry, especially in the independent parts of the industry. And a lot of agents just don't want to deal with you if you're not fully financed. It's very difficult to get letters of intent from recognizable name talent. Most of the time they'll just ask you to provide what's known as a pay or play, which means they'll block off these dates for you, but you're paying them whether or not you shoot the movie. This is an extremely risky proposition. Back on the pro side, there are lots of different ways to raise money for independent films. You can check out my video on the 10 different ways to finance an independent film up here to see what all of those are. Now, each of those different types of financing is suited for different stages of financing. We'll go a little bit more into that in a minute. But again, on the con side, if you don't have all the money in place when you get started, there's less room for things to go wrong between each individual raise. And as a result, if you don't continue to raise money to finish the film, it may never be finished. That's not good for anybody, because if the film isn't finished, all the money that's been put into the film is essentially wasted. But since you're only holding on to a portion of the investor capital at any one time, the risk is diminished. So long as you're meeting your checkpoints, the investors do have every incentive to continue to re-up their investment in your film. Because if they don't, they will lose everything they put in. While there are pros and cons to staged financing, there are also pros and cons to traditional film financing. Again, we'll start with the pro. The pro is that once you've raised all the money, it's there whenever you need it and you can use it to finish the film. The con is that you have to raise your entire budget up front. Now, I know this is the way that a lot of us are taught to do this in film school, so that doesn't seem like it's a big deal, but having actually done this in the field, it is not easy to raise millions upon millions of dollars without a package in place already. And when I say not easy, it might just not be possible. And in order to develop your package, you need to generally have some level of financing in place. A lot of times, the most effective way to package your film is to hire a very reputable casting director who might be able to get some of your talent purely on letters of intent and not on pay or plays. Hollywood is largely based around relationships, and the reason you pay that casting director, often quite a lot of money, is they have the relationships with those agents you need to get it in the hands of your talent. And that's not to say it's a cure-all. You're still going to need to have one blame the YouTube algorithm, of a script. The first money in is always the hardest to raise, and it's significantly harder to raise when the amount is larger. It does scale up like that. But going back to the pros of the traditional model, the traditional all the money up front model is much better known to these agents, like I said earlier, and it tends to be how Hollywood has operated for quite a long time. As a result, attaching recognizable name talent to a fully financed film is much, much easier. If you've got all the money in place you need to make the multi-million-dollar picture, getting the talent is not trivial, but is not that difficult. Not compared to putting together the package when you have next to no money. If you are raising all your money up front, you're holding on to a lot of money from your investors and other sources. As a result, the APR on the ROI for your investor tends to be lower due to holding onto it for a longer period of time. To de-jargonify that a little bit, the APR is the annual percentage return, and the ROI is the return on investment. So since you're holding on to the money for a shorter period of time, the APR goes up even if the ROI remains the same. And both of these numbers matter significantly when an investor is considering your project. If you've got a question about that, put it in the comments. So now let's talk about what the actual stages are in much greater detail. Stage 1 is development, and the primary purpose of the development round is to package your film well enough so that you can get the next round raised. This is the money you spend to pay the casting director to attach your recognizable names and get the team together so that you can actually have a chance at raising the vast majority of your money, which will be spent throughout pre-production and principal photography. This is normally about 5 to 10% of your total budget, depending on how high your above-the-line costs are, particularly your costs for recognizable name talent. The best types of money for this stage are from crowdfunding, and I mean donation-based crowdfunding, and I know nobody's going to want to hear that, but that is true, especially on the lower end. Skin in the game, equity. Equity is always viable, but in order to get them in at this earlier stage, you should offer them a bit of a bigger piece of the pie in order to get them to take the bigger risk at this stage. Because once the film is packaged, it's significantly less risky for future investors. The people who gave you money early on in order to get that package together, they're going out on the biggest limb, and as such, they should be rewarded for that. And finally, there's soft costs and deferrals. This is where you call in all your friends and all your favors to get the film done, to get the materials ready so that you can actually package it to raise the money you need to attach the casting director and the people who won't work on deferral. Sometimes you'll have to pay a bit to certain levels of consultants to get things like financial projections done, help you get your business plan up to snuff, and your deck and all of that sort of stuff. That's actually how I come on to a lot of the projects that I end up playing a role as executive producer on. And you can sometimes find grants here, but those are extremely difficult at this stage. There aren't many grantors that grant to development stage projects. The Kenneth Rainin Foundation is one, but they're very picky about what they take, and the sorts of films they take often don't have much of a spot in the marketplace when the films are done, which makes other parts of the fundraising harder. Here's a guide to the best realistic ways to get your first money in. Those are equity, crowdfunding, tax incentives, grants, and skin in the game. And as I said, all 10 of those ways are in their own video, which is linked in the description. In terms of prioritization, on the 5 that are realistic for first money in, those are crowdfunding, grants. The only reason tax incentives are this low is that you need to have the entire film financed to fully liquidate these tax incentives. You can, however, say that you will be shooting in this state or this country in order to best utilize their tax incentive. You'll be monetizing it using this company or this method in order to help your investors understand your financial mix at an earlier stage. And then there's skin in the game, which is preferable because you will because if you have the money, this would be the place to spend it, as the equity you're going to have to go after is going to be extremely hard to close and extremely expensive at this point. Wait, how can money be expensive? Well, you'll be giving up a lot greater percentage ownership of your film if you get equity at this stage. In general, I say it should be about twice as much as the later round investors. Stage 2 is pre-production and principal photography. This is the money you need to actually, shoot the film. It doesn't make any sense whatsoever to do separate raises for pre-production and principal photography, as pre-production is kind of pointless unless you get through to principal photography. As we all know, pre-production is primarily putting everything in place for principal photography. This is the vast majority of the cash you're going to raise. It's going to be 55 to 70% of the total raise. The 55% tends to be closer to the mark on bigger productions. The 70% tends to be on smaller productions. And the best types of money here are tax incentives, pre-sales. Yes, they are still a thing. Product placement, equity, and of course soft costs and deferrals. Which of these tools you use is highly dependent on the size of your budget and the sort of film you're making, and if you've made films before. Next up is post-production and completion. The purpose of this is to take all that stuff you shot and put it into a finished product that you can then sell. It's about 20 to 30% of your total raise. 30% is on the bigger budget, 20% is on the lower budget. Of course, this varies significantly depending on how effects heavy your film is, but I am just kind of assuming that the people who are going to be watching this are not giant studios making huge big budget sci-fi action movies or superhero movies. I mean, if you are one of those people, thank you for watching. I do work for hire. And if you're not, I also work on a sliding scale. The best type of money here are grants, because grants are much easier to get the later on in the process you get to. Backed debt, tax incentives, again, because if you're paying people in that state, they tend to look kindly on your tax incentives. Crowdfunding, sometimes this will be a secondary raise or even a tertiary raise. You can use equity at pretty much any stage, but it is less advantageous here. And if you're needing to raise equity, it can start to dilute the pie more than your other investors might want. At that point, you'd probably just have to start going back to your existing investors and talking to them about giving a little bit more in exchange for your points. You as producer and production company points. And soft costs and deferrals would be next. Skin in the game after that, if you have to. And then if you really are up against a wall, you can consider unbacked debt or bridge loans. These are extremely expensive, and you should avoid it if you possibly can. But if you need to, it's better than not finishing the film. The reason unbacked debt is so bad for you as a filmmaker is that it's extremely high interest. It's not quite giving the payday loan companies a run for their money in terms of the usury that they're charging. It is kind of close, though, and much too close for comfort. I've heard numbers from when the banks were running things that it could be as high as about 50% APR, which is insanity. But since Slated entered the market, a lot of the investment that comes through them is more based around unbacked debt, and they've brought that rate down to 25 to 30%, which is still way too high, but it's a lot better than 50%. And finally, the last stage is the producer's contribution to prints and advertising, or marketing and distribution, depending on how you want to look at it. The purpose of the stage is to increase awareness of the project and make it available for purchase to help stakeholders recoup. This is all marketing money. I say it's 5 to 10% here. That could very well be conservative in this day and age. You might need to go as high as about 20% on it. And the best types of money are impact grants, product placement in kind, or on behalf of. And what I mean by that is most of the time, if you are lucky enough to get any sort of cash for your product placement, it is normally spent on your behalf. Like the reason that Iron Man eats a Whopper instead of, a realistic burger that someone like him would eat after just getting out of the situation he was in is product placement. And then there was a huge Burger King tie-in at the time as well. So yeah. Then there's back debt. Normally you would have had to raise that back debt at an earlier stage for it to be applicable here. Gap debt you can do because it's very short term, but it's still not necessarily advantageous. And then the distributor will often put in money to cover a lot of your materials and other things like that. However, when that happens, the filmmaker often loses say over how their film is marketed, and that can sometimes be not so much in your best interest if you're working with the wrong distributor, that is, or more distributors than you'd think, really. Thank you so much for watching this, and if you like this sort of content, please like, subscribe, and smash that notification bell. This YouTube thing is still something of an experiment, and it is far from the full-time job that I do. If all of it just seems like it's a lot for stage financing, all the 10 different ways to finance your film, I do consult on exactly these things. So you can submit your film right over there, and when you do that, you will be taken to a page where you can submit your early stage project, or submit your completed project for distribution. I'm also considering launching a couple of training programs, I suppose you'd call them, for filmmakers who want to go through all of these and get some guidance and mentorship along the way, because it is all a lot and it's way too much to really go into, even in video formats or blogs or anything like that. So yeah, I guess so finally, if you have made it all the way through this, you must have really liked the project. So engage with me in the comments. It helps the YouTube algorithm and helps with discovery to help grow the channel, so that we can actually help more filmmakers understand the business of film instead of just the art. So thank you again so much. I'm Ben Yenny, and I'm not a filmmaker. I help filmmakers just like you make money with their work.